Good afternoon, traders. I want to thank you for taking the time out of your busy schedules and holiday weekends for being here today. And thank you to FX Street, a wonderful resource for traders, for inviting me to speak about a topic that I am so very passionate about, surfing the Elliott Waves for maximum profit. My name is Jody Samuels, and with over 20 plus years of trading experience in both an institutional and retail setting, I have worked with many traders, teaching them what I believe is imperative for success in trading, an understanding of the Elliott Wave cycles. On that premise, we will begin in the hopes that I can transfer some of my enthusiasm and knowledge to you in this very short time slot. This is only going to be an introduction, however, and hopefully in future webinars we will be able to get more advanced with more trade examples. So thank you again for being here. Please feel free to ask questions as we go along. And read the disclaimer to yourselves. Okay, today's webinar is going to be about the following. We're going to talk about the 3 pillars of trading success. We're going to look at some Elliott Wave Theory and talk about high probability setups. Then bear with me when I talk about supporting the trader and the services that we offer. And finally, we're going to wrap it up with the EURUSD Wave Count in the next 45 minutes. The 3 pillars of trading success include 1, analysis, 2, strategy, and 3, coaching and accountability. And by analysis, we mean understanding the market cycles, because that will help you when you get into a trade, and that will also help you to stay out of a trade. And we do that through Elliott Wave analysis. The second pillar is the strategy. Our strategy of choice is the Wavy Tunnel, but if you have a proven strategy to use, whether it's price action or some indicators on a chart, the most important thing is that you know when to buy and sell, where to set your stop, and where to take your profits. And by having a backdrop of the Elliott Wave counts, that will certainly help you in your trade placement. The third pillar of trading success is coaching and accountability. When you look inside a mirror, who do you see? You see yourself. And who knows what you tell yourself on a day in and day out? So it's important for traders to be accountable to a coach or a mentor, to stay truthful and in the now and not in your head. I'm sure you can relate to that. Let's delve into point 1, analysis, Elliott Wave. So a key pillar of achieving consistency is to have a thorough knowledge of the market, to determine the future scenarios, possible future scenarios, in order to be prepared to take advantage of these trading opportunities that arise. In our system, we use Elliott Wave analysis as our roadmap. It's in order to have market context, which will increase the likelihood of successful outcomes. The second strategy is the strategy. And you need an easy strategy to understand when making a trading decision. So after a good analysis, after a good Elliott Wave analysis, and also looking at the fundamentals, a strategy is used to identify the exact entry point, stop loss level, and goal, and to know when to trade and when to stay out of the market. As I said, we use the Wavy Tunnel. You might have your own strategy, but removing the emotions is key. The Wavy Tunnel is a manual trading system which identifies 5 different setups, and we will learn about all of the market cycles in this presentation so that you know when using your own strategy, you know which cycles you need to get into for maximum profit. And finally, coaching and accountability. This is the FX Traders Edge team. To combine all the knowledge and apply it properly, you need this third pillar, which is coaching or mentoring, an expert to evaluate your trades and give you feedback to correct the mistakes and polish the entries and exits. It might all be about tweaking. Whether you're a novice trader or an advanced trader, everybody needs a coach. And you know that when you exercise, you know that when you play an instrument, everybody needs a coach. It's no different for trading. So I'm just going to introduce briefly my team. That's me, Jody Samuels. To my right, we have Juan Maldonado. Juan is a professional trader and analyst for 7 years. He's highly qualified, and he's our master Elliottian. And he also writes for fxstreet.es. John Thomas has over 5 years experience trading stocks, options, and Forex. He's certified in NLP, and he knows over 400 programming languages. Neil Bradford is a management consultant, and he's been trading Forex for over 6 years. He uses Elliott Wave as his roadmap, and he develops trading tools for our traders on money management and risk management in particular. Vince has over 7 years trading Forex and options. He uses price action and pattern recognition in Fibonacci. Great trader. Rob Niss has over 30 years trading experience. He's proficient in technical analysis, Elliott Wave analysis, and the Wavy Tunnel, and he manages our stock and options room. And Fernando Luna has a BA in political science with a minor in psychology. He's traded Forex since 2010, and he's a certified Elliott Wave analyst. So that's our team. Now let's get into the details of Elliott Wave analysis. Who is R.N. Elliott, and what was his discovery? Well, Ralph Nelson Elliott developed the Elliott Wave Theory in the 1930s by studying various market indices over a 75-year period. In fact, he was bedridden with an illness. And can you imagine? He poured over hundreds, maybe thousands of stock market charts, stock market data while he was bedridden. And that was before computers. And what he discovered was that stock markets thought to behave in a somewhat chaotic manner, in fact did not. They made sense. They traded in repetitive cycles, which he discovered were the emotions of investors. So when the investors got excited about buying a certain stock, the market would move up perhaps. And of course, it also had to match the fundamentals at the time. So what he found was that the market patterns were based on the predominant psychology of the masses at the time. And of course, it was later learned that this can be applied to any market and not just the stock market, including Forex, our market of choice. So Elliott's work was published in 1938 in a monograph titled The Wave Principle, which has become known as the Elliott Wave Principle. And here, he described how patterns are tied to collective human behavior related to the Fibonacci sequence or the golden ratio. In 1978, A.J. Frost, in collaboration with Robert Prechter, wrote the Elliott Wave Principle, and this is considered one of the most definitive textbooks on wave theory, and this is the work that I have studied. The illustration in the middle looks complicated, but in fact, it reflects the wave principle, the 8-wave cycle. And the principle states that in any market cycle, waves will subdivide until a complete market cycle is established. And as the market unfolds, which is governed, as we now know, by the psychology of the traders, they have predictive value. So imagine if you learn these patterns, you can begin to see how they will unfold once they begin their patterns. We're going to learn the patterns, and we're going to talk about the patterns. It It's very important that we learn these patterns so that we will be more apt to recognize this market movement as it occurs and understand when we want to be in the market and when we want to be out of the market. The foundation of Elliott Wave Theory is based on the science of chaos, which is that complex shapes look the same at different orders of magnitude. But what is our takeaway from this slide? The takeaway is the word fractal, where similar patterns composed of smaller and smaller copies of themselves copy until infinity. And this is most noticeable in nature. For example, in this picture, in the clouds of the sky or the branches of the tree. So if you look at the small branch, it is really similar to the tree itself. Well, this occurs in Forex markets, or in any market for that matter as well. Can you really tell without knowing whether a market which is unfolding is actually a daily chart, a 4-hour chart, or a 1-minute chart? Whether a monthly, weekly, daily, or 4-hour chart, the patterns repeat themselves. So this enables one to trade any time frame using the Elliott Wave principle. Not only can you trade any time frame, but you can trade any market. If you just trade currencies and you look at 20 different currency pairs, you will see the same patterns developing time and time again in all of these currency pairs. And if that's your style of trading, where you look at a bunch of pairs and see the best opportunity, what trade is setting up at the time, once you learn these patterns and once you internalize these patterns, you will be able to look at 20 different pairs and decide, okay, 3 of these pairs are in beautiful trend moves. These are the ones I'm going to focus on today or for the next few days. And you might just throw out the rest. It's all about filtering, traders. It's all about filtering out the low probability trades and managing the high probability trades. That's what makes a trader successful. Taking advantage of the high probability trading setups. So this is one way of doing it. Another way of doing it is to trade 1 or 2 markets, which I'm sure many of you just focus on 1 or 2 markets, and that's okay too. But just know when it's time to be in and when it's time to be out. That's very, very important. Sometimes that can make the difference between a winning trader and a losing trader. All right, this is the 8-wave cycle, the basic wave patterns. So initially we have a 5-wave structure, waves 1, 2, 3, and 4, and 5, followed by a 3-wave correction, A, B, C. Now this 3-wave correction is, this is the perfect 8-wave cycle, 8-wave structure. The 3-wave correction on this slide is called a zigzag. And a zigzag is one of my favorite high probability setups. So I'm just going to talk to you about that for just a moment. You see the A, B, C, and it's very similar on the other side to 1, 2, 3. So whether or not you're an avid wave counter, you can certainly count to 3. 1, 2, 3, or A, B, C. The setup that I'm about to tell you is called the equality setup. So if you see a move down, a trend move down as in the A, followed by a correction as in the B, you can anticipate another move down in the same magnitude as the first move down. In other words, this is called the equality setup, and you can expect that wave C will travel at least the distance, the number of pips, as that wave A. So that is the point, that if you look for setups which begin with a trend move followed by a correction, you can anticipate the third leg trend move to be the exact same length as the first move. That is the minimum target. You can look for these setups all day long without really understanding how to count the waves. And since the ABC zigzag is a replica of the 1, 2, 3, you can actually get in on a trend move 1, 2, 3 and forget about waves 4 and 5. This is just one high probability setup. But let's talk about the wave personalities. The wave personalities are really important for you to begin to understand the market cycles. And we'll try to add some insight here as best I can. Wave characteristics, the wave personalities, are a direct reflection of human market behavior. And wave personalities exist at every level of the wave count. So we call the start of wave 1 point 0. And when the 5-wave trend move ends, we call that point T for termination. Let's begin with waves 1 and 2. When the move is just beginning, the market is very less emotional because they're thinking that we are still in a downtrend from the previous move down. They have not recognized that we've had a change in trend as of yet. There are no momentum clues yet for a change in the trend. The price action is less emotional. There's little or no volatility, as the traders are still bearish at this point. So market participants are really still in sell mode since no change in trend is evident. So once wave 1 ends and wave 2 begins, because the market is still bearish, traders are selling. So wave 2 movements are usually very sharp and steep, oftentimes correcting most of wave 1. And this is where you see your double bottoms happening. You see at least 61.8% Fibonacci retracements of the wave 2 for the wave 1, and you see your double bottoms. Once you learn how to figure out the end of the trend and you can anticipate the start of the new trend, well, then you are ahead of most of the crowd. And one way to enter early, or one way to enter in this type of scenario where the new trend is beginning, is just to wait for confirmation for the market to take out the top of wave 1. And this is actually called a 1, 2, 3 pattern. It's an end of the trend pattern where the point 1 is labeled at the beginning of the move and the point 2 is labeled at the top of wave 1. And the wave 2 corrects down to point 3. And once wave 3 starts and takes out the top of wave 1, that is your 1, 2, 3 reversal pattern kicking in, and you should seriously consider entering. And entering for the duration of that wave 3. Measure the wave 1, project it on the wave 3. We just talked about the equality setup, so why not just capture that bit of profits, the equality with wave 1? And one way of entering is on the 1, 2, 3 reversal pattern when we take out the top of the wave 1. Another way to enter is if the wave 2 corrects most of wave 1, you can certainly buy the wave 2 on its retracement with a small stop below the start of wave 1. Then you're getting in really early. There's a lot more to say about this, obviously, but I want you to think about those two ways of entering the end of a trend. And traders need to understand how to take losses too. So if by chance you do get in at the end of the wave 2 with a stop below the wave 1, as long as you use proper money management, it's possible that it's not the end of the move down yet, and you might get stopped out, but then you look again because you've done the analysis to show that a trend reversal is due, and you don't want to miss it. So that is the personality for wave 1 and wave 2. Now let's talk about wave 3. Wave 3 does give us the greatest profit potential. Robert Prechter calls wave 3 a wonder to behold. One way to recognize a wave 3 is by its steep slope and rocket thrust movement. It almost moves straight up with very, very few corrections in a very steep wave 3. It is generally steeper than wave 1, but not always. And when wave 3 sometimes seems almost vertical, it means that you need to get in. Not at the top, of course, but when it's first starting. And during the wave 3, the economic background begins to support the move, and the fundamentals begin to support the move as well. In the last several weeks in the currency markets, we have had some unbelievable trend moves, huge wave 3 moves to take advantage of the market volatility. Market volatility also increases during wave 3s. And sometimes wave 3s extend. When we are in a strong trend move, you often see an extended wave 3. So the initial target that I talked about, equality with wave 1, that's the minimum target. But the most common wave 3 target is 1.618% times wave 1. An extended wave 3 target could be 2.618 or 4.23%. So we can have a very long extended wave 3 where it's no longer 5 waves, but it is either 9 waves or 13 waves or 17 waves long. That's right. I've added 4 to the 5 to get 9. I've added 4 to the 9 to get 13. I've added 4 to the 13 to get 17. So when you surpass 5 waves in what you think is a 5-wave trend, you've got to say to yourself, here we go, extension in the works, I'm looking for 9 waves. And then when we surpass 9 waves on the move up, that means 1, 2, 3, 4, 5, 6, 7, 8, 9, you have to start thinking 13 is the next target. This is very subtle, but remember it for wave extensions. Back to wave 3. The point in discussing this is to say that during a wave 3 does not have to stop at equality with wave 1. It can go on and on and on. And therefore, you need a system which will get you into the trend move, the biggest move. It is said that trends occur 30% of the time and that corrections occur 70% of the time. So you have to think of yourself, well, as a lion sitting in the lion's den, sleeping, and then getting up to yawn and to recognize that, now it's time to get up and to find my prey. Well, that is the mentality that your mindset should be in, where you, during the wave 2, you're not necessarily sleeping, but you're waiting, and then you wake up and you take advantage of the wave 3 move. So it's during the corrective moves, the wave 2, for example, since we're talking about wave 3, that you want to prepare yourself for the wave 3 move. You don't want to say nothing's going on. You want to be on your toes. You want to be on your feet to know that something is about to happen and you want to be there to seize the opportunity. Enough about wave 3. Now let's talk about wave 4. Wave 4 is all about profit taking. This is where the early traders, some of the institutional traders take their profits. And this is also where others enter long and witness whipsaw price action. So for example, are you a trader who is going to not get into the wave 3 because it didn't correct as much for you to get into the wave 3? And so finally, when the wave 4 corrects, you're 38.2%, you're going to get in. That's fine, but just recognize that all wave 4s aren't created equal. and that the wave 4 correction could be a bit of a complex corrective sequence, which means that you have to be very, very patient in a wave 4. And as long as you recognize the personality of a correction and you stick to your conviction and you have your stop loss there, just know that when the correction ends, we will have a wave 5. But it is very often that traders do get chopped up during wave 4 moves, because sometimes the corrections last a bit longer and don't retrace as much as the wave 2. So the typical retracement for the wave 4 is between 38.2 and 50% of the wave 3. So you would measure the wave 3 length, run your Fibonacci tool on it, and look for a 38.2 to 50% correction for the wave 4 to get in for your wave 5 move. But don't get chopped up. Wave 5. So wave 5 is the final advance to point T, the termination point, and it's the trader's last struggle to create new high prices. And sometimes the wave 5 double tops with the wave 3, and this very oftentimes happens in the currency markets. And other times, most times, the slope of the wave 5 is less steep than the wave 3, and it can seem very choppy with overlap, and that's called an ending diagonal in Elliott Wave terminology, also called a rising wedge in standard technical analysis chart patterns terminology. So when you see a rising wedge or an ending diagonal and you draw your trend lines, you connect the tops and bottoms with your trend lines, when we break down, in the case of an uptrend, you have to know that the wave 5 has completed, and you will also see momentum divergences between waves 3 and 5. It has completed, and we're ready for a correction. Now, all of the charts that I've shown you so far are for uptrends, but just know that the exact same thing happens for downtrends. Okay. So uptrends, downtrends. We're just doing uptrends. Now this is the summary slide, and this shows you the 8-wave cycle. So at this point, you probably have a better understanding about what the wave personalities have to do with trader crowd behavior. And you might also be interested to know that winning traders that follow Elliott Wave Theory do go their own way, and they try not to follow the crowd. They develop the mental mindset to be independent. So while independence is essential for trading success, it's also a skill that can be learned once you understand the way markets move in cycles. So what would successful traders do in looking at this diagram? In this diagram, successful traders would look to buy at the bottom of wave 2 and wave 4 above in order to take advantage of the wave 3 move and the final wave 5 move. But successful traders would also understand how to measure, how to calculate the end of the trend move in order to get out of their positions at the end of the trend and then wait to initiate a new position, a counter trend position. That can be dangerous. You need to be very, very experienced with that, because too often, retail traders especially, tend to get out of their positions too soon. It's really an art to stay in your position. It takes longer without getting out. And you can learn that. You can practice that. You can practice staying into your position. It's more important, though, not to go against the trend before the trend has turned. And too often, traders tend to try to pick a top on the market and go against the trend. Before you do that, you must be able to see divergence between the waves 3 and 5. You should also be able to recognize if we're in an extended wave or not. So we already did a little exercise to show how you can show wave extension if we go beyond 5, add 4, etc. So these are just some little tools that you can use to make sure you don't buck the trend, which is really, really very important not to do. So with our system, the Wavy Tunnel, we break our trades down into 2 types. The trend following trades, and there are 3 setups. And then the end of trend trades, and there are 2 setups. So no matter what trading system you're trading, it's very important to get into the trends when they're occurring. You might also use a good Elliott Wave counting service to be your roadmap. For me, it's like my crystal ball, because I understand the cycles, the wave cycles, and I've internalized them. I understand the patterns. And it's these wave patterns, when I see them setting up, I can recognize what patterns will follow. And this is something that you just learn with time. I've always had an Elliott Wave analyst sitting by my side. From the time I worked for JP Morgan in New York, I always had an Elliott Wave analyst sitting by my side. And then when I went out trading on my own, I, of course, developed the expertise myself and did not rely on anybody else for the longest time, because I was able to count the waves myself. So again, trend following, your system needs to have some trend following setups, and also end of trend. But you don't need to take all types of trades. If you are a trend trader, and in these markets there are so many trends, you can just stick to the trends and not look for the end of the trend. Wait until it starts. So by waiting until it starts, you might wait for the first move down where the A wave is, and we already discussed this setup, the ABC, then calculate the corrective pullback for the wave B, and then get in to the wave C. So in this case, you're not bucking the trend too soon. Now, with your permission, I'd love to show you the services that we offer and to see if you might like to join us, because we do have a very special offer on fxstreet.fxtradersedge.com. We offer 3 services, and this is our bundle package. We offer a counting service on 17 markets: the euro, the pound, the Aussie, the euro yen, the dollar Swiss, the Kiwi, the euro Aussie, the pound yen, the S&P gold spot, oil, the dollar index, the Dow 30 index, silver, copper, and the US 10-year yield. So we are providing these counts. And the second service is the Forex trading room service. We have the London session from 2:45 a.m. to 5 o'clock Eastern, the New York session from 7:45 a.m. to 10 o'clock Eastern, and we are going to have an Asian session starting next week, once a week, from 7:30 to 9 o'clock Eastern. And then we have the end-of-day stock and options analysis room. Many of our traders do trade stocks as well as Forex, so we do that twice a week from 4 to 5 Eastern. Just a bit more on our services. The wave counts are produced prior to the Asia London Market Open and during the New York session. And there are 5 weekly videos produced with the wave counts from the weekly down to the 15-minute. We often offer additional webinars. So Juan is our brilliant Elliottician, and Fernando works with Juan to provide these excellent wave counts. In the Forex trading room, we also provide daily wave counts, but the traders, the moderators that manage the trading room, they look at price action, they look at support and resistance, they look at the Wavy Tunnel, they post a daily trading summary prior to each session, and they have a Skype group to keep connected between the sessions. We also have special webinars posted and many, many trading room tools which will help with money and trade management. And finally, the stock trading room is open for any trader that wants to get their stocks analyzed by request. So these are our services. I'm just going to show you what we're offering. We're offering a special 7-day trial for a penny. So you can do this for free. You can try out all 3 services for 7 days. And after that, we usually charge $199 a month. For FX Street, we are going to charge $149 a month if you subscribe today or tomorrow. So this is your special. So this is what we offer, and I know I promised you that I'm going to do the EURUSD Wave Count. So that's coming up. Are there any questions? Are there any questions? So please ask your questions, and these are our specials. I'm going to go to the EURUSD Wave Count, but just take note of the website to find these specials, fxstreet.fxtradersedge.com. I'm just going to type it in, and then we're going to do the wave count. All right, here we go. This is the EURUSD daily chart. We are currently in an ABC corrective cycle. So it's the same corrective cycle that we just spoke about. You can see towards the right the A magenta moving down. Let me see if I can just get a pen here to annotate. Here we go. So here is the magenta wave A. So this is the first trend move down that we just discussed for the ABC, followed by a 3-wave corrective move for a B. And what happens next? What happens next is the C wave. So even if you don't know where we are in the broader count, this is the pattern that is setting up, that is suggesting. By looking at the smaller time frames, you can certainly get in on retracements. We will be looking at the smaller time frames. We're going to look at the 4-hour and the hourly as well. Confirmation for this move will be a break below this point here, the A point. And this is the 1, 2, 3 pattern that we talked about. So we talked about the start of the move is point 1. This would be a point 2, and this has nothing to do with the wave counts, by the way. And then this is the point 3, and a breakout down through this will be a confirmation. You're getting in later here, obviously, and this is the daily chart. So I would suggest looking at the smaller time frames and seeing if you can get in on a retracement. Now let's go down to the four-hour chart. This is the 4-hour chart. And here the wave C is broken down into its subwaves. We have a 5-wave sequence, which is then labeled as a wave 1, and now we are in a correction, an A, B, C. So we are anticipating the market to complete this correction for its wave 2 before the next move down. Now let's look at the hourly chart. Now, some of you are probably thinking, when we looked at the daily chart, if you get in below this 0.1 and you set the stop above the high, that's a 700 pip stop loss. Correct. You don't need to do that. Again, these markets are fractal, so you're going to see the same patterns on every time frame. So again, I would look at the smaller time frames to get in. So for example, here we are on the 4-hour chart. You might wait until we complete this wave 2 and that the market turns around and you could get in on the hourly chart. What I like to do is to get in on a smaller time frame and manage my trade on a bigger time frame so I don't miss the big picture. And there's a whole lot more to say about this. We have 4 minutes left, so I really can't say too much more about this because you could write a book on how to get in and where to get in and when to get in, and it is also a function of your trading personalities. Right? Let's look at the hourly. The hourly chart looks at the entire wave 1 move, and it runs a Fibonacci to show what the potential wave 2 correction might be. 23.6% takes us to 130.87. 38.2% takes us to 131.50. And then a 50% takes us to 132. So this is what we're looking for. Certainly, if we take out this bottom here, we have to reevaluate. But for now, it seems like the C wave hasn't completed yet. So this is our wave count on the euro. Are there any questions? You can certainly get in touch with me at jody@fxtradersedge.com if you have further questions, and that's my phone number. So please feel free to reach out. Now let's look for questions. Gann and Fibo fans seem especially useful for this. Absolutely. If you know Gann and if you use your Fibo fans, absolutely, it's all related. Why? Because it's all based on Fibonacci, and Fibonacci is the basis for Elliott Waves. Any tip for Elliott Wave users from you? Well, I would make sure that you have a good Elliott Wave service that you're using and a great strategy. And from that, you can learn how to count the waves yourselves and label the waves yourselves. It's important to keep your charts updated and have your Elliott Wave analysis as well as your wave counts. As well as your trading strategy in mind. I like to use Elliott Wave for the analysis, and I use the strategy for entry and exit. Another question. What if a trader just uses higher highs and higher lows? Excellent point. Absolutely. A change in trend will be let's say, moving from the downtrend to the uptrend would be higher high, looking for the higher high and the higher low. Absolutely. Draw your channel lines, and that's obviously something that you need to use. Is 3 always the longest wave? It's not always the longest, but most of the time it is. Do we cover the African markets as well? Not regularly, but we are always available to look at markets on request. What do I think about Neo Wave as the new Elliott Wave? Well, Fernando, one of our Elliott Wave analysts, uses Neo Waves as well as the Prechter work. So we do look at his work. I personally I listen, but I personally haven't studied his work. Minimum target will be A equals C. Absolutely, that's the minimum target. And if C is extended, then it will extend. It will be longer than A, but that's the minimum target. Is there a Fibonacci relationship between waves 1 and 2, or 3 and 4, or A and B? Yes, there is. The most common relationship for the waves 1, for the wave 2 relative to wave 1 is a 50 to 61% retracement, and most often it even double bottoms. It goes as much as 100%. It's steep. And 3 and 4, again, wave 4 isn't usually as steep. Usually retraces between 38.2 and 50% of the wave 3. A and B, that depends on what corrective pattern it is, whether it's a zigzag or a flat pattern or a triangle pattern. Do the waves show Fibonacci timescale relationships? Yes, they do. You can certainly measure time as well as price. You will see the same. You will see Fibonacci relationships using time as well. Are there any probability studies done for the Fibonacci relationships? There have been many, many studies done. I can't cite them right now, but this is the work. This is the work that many, many people since R. Elliott have studied. Is wave 2 always longer than wave 1 in time? Not always, and I can't confirm that. Will wave C retrace the previous wave 4? Excellent, excellent. Okay, good point, and then we'll wrap it up because we've gone past our 45 minutes. That's an excellent wrap up. When we complete the five wave sequence and we have a correction, an ABC correction, look for the ABC correction to move back to the previous wave 4 as a target. That's excellent. So not only can you run equality of wave C to wave A, but you can look for a second target, which is to the previous wave 4. And that's it. Well, here, there's just another question. Does a standard wave in a market usually fit within a Gann grid pattern, repeating again and again as a grid is a channel in price and time? We don't have time to discuss that question. Certainly, we are also studying Gann, and perhaps in a future webinar we'll be able to discuss Gann. So thank you very, very much, everybody. It was a pleasure. And please join us. Sign up for your free 7-day special to experience our trading services.